I can be a great company having 80% market share. I'm the monopoly, right? But I'm doing a very niche product in a very niche market, right? And if I'm already 80% monopoly, 80% market share, and the market, is not growing, is stagnant, eventually what will happen? Revenues will be flat.
Yeah.
If revenues will be flat, cash flows, profits will be flat. If cash flows and profits will be flat, the stock price will either be straight or down at some point in time. So that's one way to think about it. Now, if I have a company that's growing massively, gaining market share, delighting customers are really happy, right? Delighting users. And they're addressing a very large market. So I'm thinking about small addressing a very big. This can become so big. And the good thing about market opportunities is it doesn't happen in a day. It often takes years or decades to occur.
Before we begin the podcast, have you gotten your free ebook? It's called the Build a Six-Figure Portfolio Guidebook. Now, inside it, we share with you the tips and tricks to bring your stock investing skills to the next level. The best part, it's only 10 pages long and it's totally free. Whether you're on Spotify or YouTube, the link to download is in the description, or you can go to www.firl.co/FREE or www.firl.co/free. Alright guys, welcome back to the FIRL Podcast, best place for long-term stock investors. Today, we have a very special guest/podcast because it's going to be our first, there'll be two firsts, right? The first is that it is a Zoom meeting, right? It's not going to be the usual podcast.
This is the new normal.
And the reason it is a Zoom meeting is because this is our first overseas guest. And why? Because he's also, number two, our very first Singaporean from across the
Straits.
Yes, I always forget the. Okay. Yes. So just to give all of you all listening some background on him and why it's really impressive, right? What he has done so far. But basically, briefly, he had a past in banking, right? Citigroup, JP Morgan, mostly to do with sales. And then suddenly he switched and became the CIO, Chief Investment Officer of Vision Capital. Now, a little bit about Vision Capital. I will let him explain to you what exactly he does, but I just want to give you some of you a sense of the caliber of the man we're talking to today in terms of performance, in terms of investing performance. Now, you can actually find it on his website, but basically, he has made 230% over the past 3 to 4 years compared to the S&P 500, which is 70% as of March 2021. So it's very recent, right? And he's also an author of a book called Vision Investing, How We Beat Wall Street and You Can Too. So the man, the myth, the legend, Mr. Eugene Ng, welcome to the podcast.
Hi, Angie. Hi, John.
So how is, before we begin, how is Singapore and COVID and all of that?
I think Singapore is recovering. I think 25% of the population is getting vaccinated. So I think we're just looking forward to getting vaccinated and slowly getting back towards a bit of a sense of normalcy.
Okay.
How about the investors in Singapore then?
I think the investors in Singapore, they are coming around. I think more people are starting investing because of the dip last year. So I think we're seeing people coming from the passive investing side, typically when they're just doing indexing
or ETF.
ETFs, exactly. And then now they're starting to take a more active approach in investing. I think that's taken a good positive spin. I think money has gotten a bit more, I would say, more passive over the many years. Wow. It's good to get a bit more active, and I think people are taking a bit more charge in that. So I think overall it's a step in a good direction.
Great.
All right. I had a question.
Yeah, I had something related or unrelated about the travel bubble, because I last kept note probably about 3 months. I thought Singapore and Hong Kong wanted to create this travel bubble.
Yes.
Is that happening, or has it happened yet?
No, I think it hasn't happened. I think we wanted to, because I think Hong Kong was having a good control of the COVID virus, but eventually I think because of Hong Kong, they had new waves coming up, and then eventually we stopped the travel bubble. So I think we're trying to get it up. I think Australia and New Zealand has started already. Okay. Hoping maybe we can start one with them.
Yeah.
Sure. Okay, so I just want to get a feel of your background, right? So what I find interesting, apart from the fact that you've been a household name like Citibank, JP Morgan, and whatnot, is that you actually made a switch from more sales-oriented, and please correct me if I'm wrong, but a more sales-oriented part of finance into just pure, data analysis kind of investing, right? It's different skill set, right? People talk about investment banking, and they think that everyone's the same there, but it's a very big field, right? And what I've come to realize, at least in my experience, is that people who are good at sales generally not very good at investing. But you seem to buck that trend, right? So you want to share with me, how did that transition even happen?
Yes, so I started my career with Citi as a management associate. So this was back in 2008. I think 2007 was the financial crisis. Mm-hmm. I had finished the Asian financial crisis without a job. So I graduated, and then I think in 2008, I remember, I think I was one of the last ones to make into Citi's management associate program in Singapore. And thankfully, I joined in October. And of course, the stock price, I bought the stock of Citi, and I remember it was at $5.
Yes, it fell all the way to $5, yes.
Before you knew it, it went to $1.
Wow.
You couldn't get lower, it went lower, right? And of course, subsequently, we had the reverse stock split, and the stock never went back to where it was. I think importantly, that was my first ever investment, really buying about something that could never go up. I mean, who could go back up, but eventually didn't. So I think that gave me a bit of a foray. But I think after that, I moved in Citi. I started off doing credit cards marketing, insurance, moved to FX sales, then moved to JP Morgan, and I was doing FX sales for 8 years as well. But back then I was dealing a lot with corporates, and I kind of liked what I was doing. I think more importantly, the way I would, if my grandmother would ask me what job did I do, right? I would tell her, I was kind of like a money changer, helping corporates change money. If someone needs to convert dollars into euros, I'll help them do FX. It's just that you don't see the paper money. You probably see it in numbers. So that was kind of how we were doing, and we were really just advising, treasurers, the finance managers on how best to hedge. I think if I were to reflect back in JP from that job, it was very solution based. Ultimately, because I'm actually a bit of engineering trained, I'm very mathematically inclined. The way I think about it is always to be thinking about a solution, a problem. And with a problem comes constraints. So that has always been kind of like my sales approach. It's been not very pushing kind of approach. It's just really very solution based. So when a customer has a solution, I'll think about something. So I think when the natural pivot actually came was, as you wanted to share, was that in about my third year in JP Morgan, I had a very tragic accident. So back then, I think there was, I should remember, it was Eve of Christmas.
Wow.
I was at a beach club. I was having a lot of drinks, and I decided to do a somersault into the swimming pool of the beach club.
Okay.
And please, kids, do not ever do somersaults into the swimming pool. So what happens was that the top of my head hit the bottom of the swimming pool.
Oh gosh.
The floor of the swimming pool, and I heard a loud pop.
Ooh.
And before I knew it, my head was really loose, and thank goodness I could still feel my arms and my limbs, and I basically got sent to the hospital. And I was in the hospital bed for about almost close to about, I think, 5 days, and I was getting pneumonia. And that's where I found out I actually broken my neck.
Wow.
I broke my neck. So what happens is that if in the human cervical spine, we have what we call the C1. The C1 is the very first bone right at the top. I actually broke that into 2 pieces. So kind of like broke into 2.
Wow.
And what happens is that it went through a very tough process of about the next 3 to 4 months where I actually had to wear a halo vest. So a halo vest is kind of a thing that you kind of put in place to hold my neck so that my bones will come back and join together.
Mm-hmm.
So effectively what I had was, I did an operation where I had 4 things drilled into my skull. 2 right here and 2 right here.
So
they were basically drilled into my skull and hold that in place, kind of like a human cast, just to hold it. It was very, very painful. I was carrying like probably 3 to 5 kgs of that metal structure for almost, I think, 2.5 months or
Your
even
neck strength must be off the charts.
No, actually, the neck strength became so weak because you weren't using it.
Right.
Yeah, so there was it was a very humbling experience. How serious that is. So this was actually called a Jefferson C1 fracture. The doctors and the physios actually told me that the 90 or 95% of people who kind of get this actually die.
Oh, wow.
Of that who actually survive, the 5%, 90 to 95% of them actually have some form of paralysis.
Wow.
And when you think about it, I'm in the lucky 1%.
Wow.
To be able to be just walking, though it's still broken. So actually the back actually joined, the front is still open. But I think I take it as every day it's a living miracle. And then I think that's where I kind of pivoted myself into investing. When my wife told me, you're great with math, right? You're great at something. Why not you choose and do something with your life, right? So I think that was a kind of a great push because I wanted at that point of time to really figure out what best I could do in my life. So I think that was kind of that big shift and trying to figure out. I would say this was probably maybe around about I would say almost close to 8-10 years ago.
Were you married back then when you had this accident?
No, I wasn't married. So I was with my wife, then girlfriend for about just under 2 years. Okay. And of course, I think this kind of times where you kind of get really tested.
I see.
And she was there all this while. And my mom, of course, flew back from the United States to take care of me as well.
I see.
And that's where you truly know, who are your loved ones, right? I mean, she took a gamble on me. I think we were very optimistic, hoping that it would recover.
Okay.
And I'm glad it did.
Right.
Yeah.
Yes.
Thanks for sharing that.
Yeah, I mean, I don't think I've heard such a story before.
Yeah, same.
I mean, but speaking of 1%, right? Let's talk about Vision Capital, right? Because I mean, looking at your returns, I think there's no doubt that it is in the top probably 1% or 1 percentile. In investing. And before we go into your philosophy and all that, what is Vision Capital actually?
Yeah, so when I think about Vision Capital, it's really inspired by, I would say, like kind of my mentor. So my mentor is kind of like David Gardner. It's my informal mentor. I think of him as a mentor. He likes to say this, right? We should always be investing in companies that reflect the best vision of our future. And Vision Capital really, I think it's a new way of creating that. So when I structured the entire of Vision Capital, it was really just to be really focused on businesses that I think is doing good to the world, shaping and changing the world. I think that's really ultimate. So when I'm thinking about businesses and really going to that, it really just flows through. So I give you an example, right? So I come from a very humble family. My parents, we stay in public HDB flats in Singapore. Actually, what happens was that at a very young age, my parents were divorced. And the reason why was because my dad was a habitual gambler.
I see.
So we had what you call pig's head being in front of our door. We had paint splashed over our walls. My mom had to go through a lot to pay back all those gambling debts, right? So for me, for example, because gambling has actually kind of torn apart my family. So for example, when I look at it in companies, right, any companies that is doing remotely gambling, it's a strict no-no for me. Because I think ultimately, yes, they might be making money, but they're making more money off something else, right? And I'm thinking very fundamentally from that angle as well. So that's just one example for gambling. And if I think about it, for example, like energy, right? If oil and energy companies, they're giving us electricity and allowing us to travel. But in the long run, it's actually destroying a lot of the environment because of the CO2 emissions, creating plastics, and plastics is just now, is a massive problem, for example, in the environment, in the oceans. And these are companies that I don't invest because they can be there, making money, but they can't be there long term. Right. And I'm thinking very, very long term because when we're really investing, we're all long-term investors here, right? 10, 20, 30 years. So I think about it. I think about vision investing really from the angle and really focusing on companies that are just doing along that path.
Great. Just for the context of the listeners, because some of them may not be familiar, you're referring to David Gardner of Motley Fool, right?
Absolutely. Yes. David Garner.
Yeah,
co-founder along with
Motley
Garner.
Fool. Yeah.
So what other things? So I think for those who still don't know what Motley Fool is,
yes.
how will you describe Motley Fool?
I'm a fervent subscriber.
And expand a little bit more about how, I wouldn't use the word idol, but certainly someone you look up to in the form of David Garner, right, has impacted your investment journey. You explained briefly about how you should look at stocks that change the future. Maybe share with us how else has he impacted you, plus what is Motley Fool?
Yeah, I mean, let me go back into this, right? I think it really has come back into my investing journey. So I think when I started saying, okay, I was always interested in investing, and when I started reading all your typical books, your Ben Graham, your Warren Buffett, and I did actually a course in Singapore with 8i Investing. So it's a value investing based course that was kind of teaching value investing. Now after finishing the course, what happened very strikingly in that course, they gave an example of this company called Viacom. Viacom in Singapore is a car inspection company. In Singapore, it's actually a duopoly. So there's Viacom and another company that does it, and they kind of both have 50% market share, right? By regulation, every year, your car have to go through an inspection.
Right.
And if you think about it, because of that, the revenues aren't going to go away. Be it recession or no recession, cars are going to be there, right? And if you're going to be doing it, the revenues are going to be there. So they have great profit margins, and it's a great stock. It's a great dividend stock. So he gives that as an example of great investment to hold and, dividends, right? And I was looking at it. Okay, the Singapore car population is kind of flat. You can probably increase your car, the fees more or the revenues more.
Right.
Revenues are going to be flat.
Yeah.
If revenues are going to be flat and profits are likely going to be flat because profit margins are already actually quite high, profits can't grow. If profits can't grow, the stock price actually can't grow, right?
Yeah.
So I'm going to be owning a company. Yes, I'm getting 4-5% dividends, but the stock price is going to be staying flat. And I was like, okay, something is tremendously wrong here, right? I'm getting the math wrong, right? So I started doing more value investing, really trying to figure out. So obviously they say buying great companies, at 50 cents to the dollar and with a margin of safety, right? And some upside. So I was like, okay, great. I can buy top value investing, great companies who are doing really well. Top line is like, because typically when they're paying dividends, your top line is probably growing 5-10%, low single digits. Yeah. And the profit margins are already very high, right? These are solid companies, right? And then I'm looking, okay, these companies are great. But if the revenues again don't grow and if the profits are okay, and yes, okay, I'm buying 50 cents to the dollar. So if I'm thinking about it, my upside is, okay, I'm buying maybe a 150 stock worth in future value, but for 50 cents, right? So I can make double.
Yeah.
I'm like, something's wrong here, right? So I was like, okay, value investing maybe is a bit off. So that was actually when I started Googling, what are the best investors in the world, and chanced upon the Motley Fool. And I think David Garner really changed my way of thinking about it, is that I'm not buying 50 cent $1 coins, but I'm really buying $10 coins or $10 notes for 50 cents now. And that's how I'm really thinking about it, is when you're holding multi-baggers, and a lot of these multi-baggers can just offset all the losses combined, that gives you that tremendous outperformance. And that single phenomenon of just searching out there for the best investors and trying to change my whole investing framework just came from there naturally, just because of the math. Because the way I think about it, if your revenues of the stocks or the companies go up, right? And if the company is massively improving profit margins and profits grow even faster than revenues, the stock price has only but to go up. And that's just one natural way, right? Because stock price follow revenues, follow profits, follow cash flows.
Right.
Naturally. So if you keep following it, even the valuation multiples might be expensive. It might come down over time, but the stock price will go up. And that was a really big fundamental change in going back there. So when I found out, so the Motley Fool really is it's based out in the US. Is globally available. Yeah. It's actually a stock selection service. So they provide a stock selection service. They have two main basic services called the Stock Advisor, where I think Tom and David provide stock picks, monthly stock picks. They have the Rule Breakers as well, which I'm a big fan of. The only podcast only other podcast that I listen every week is the Rule Breakers podcast. I highly recommend. David Garner is great. He's been great in shaping a fair bit of my mentality.
Great.
Going to this.
Yeah. I don't know whether it's popular in Singapore, but MJ and I always get this. I'm a growth investor compared to a value investor compared to a dividend investor. What are your thoughts on that, please?
Are these phrases even meaningful to you?
Yeah.
If you think about it, I think all investing is value investing. Mm-hmm. I'm doing value investing. It's just the way I think about it. I think typical value investors, the way to think about it is right now, what is my present value of the stock, right? Versus the current stock price. Mm. I think about the future value of my stock versus the future price. Mm. So it's value investing from different time perspectives. One is the now, the other is the future. Mm. So I would say, we're all doing value investing. It's just the way we think about it is different, right? Mm. And the way I think about it is really growth. Because if you think about it, for any company, every company typically goes like an S curve, where you really go right at the beginning part when they're just finding that niche, being a top dog, and when the revenues just go crazily, immensely higher, that's where the profit and the valuation multiples just skyrocket. And you really want to be in that sweet spot where you just go up and ride it all the way up.
I see.
So I think that was just that big fundamental change.
I see.
So you use an interesting word just now, which is multibagger.
Yes.
So obviously, I think the big question is, okay, first of all, I don't think anyone listening to this podcast don't want a multibagger. But the big challenge is, what is the process? And since you're an engineer, I'm very sure you have a process. In fact, I think on your Twitter feed, the pinned tweet actually explains your process in 140 characters or less over about 10 tweets, something like that.
Yes.
Now, what is the process of finding a multibagger?
I think it goes back to the investing, right? So if I think about investing, it's really mathematics and probability. Right? So if you think about the investing world, there was a survey being done. So they put about 24,000 stocks over the last I think 50 or 70 years.
This
or so.
Global stocks, is that
global?
Right? Okay.
I think it was US stocks actually.
Okay.
But when they did that study, right, they found out that 50% of the returns was accounted by about 4% of the companies.
Wow.
Right. And so let me correct it, right? 100% of the returns more than 100% of the returns was actually accounted by 50%, about a very small 4 to 5% of companies, and about 50% of the returns is accounted by even smaller percentage, about 0.5% of the companies. That number actually went down to a very small number of portfolio, basically almost up to, if I remember, it's about 1 to 200 companies.
Wow.
Now, if you think about it, we have a normal bell curve, right?
Yeah.
The very small part on the right-hand tail accounted for all that returns. So if you think about it as an investor, actually the majority of the companies, you probably won't be a winning stock.
Yeah.
When you think about it from it's about math problem. For me, it's about how do I find these companies on this very right tail, hold them for the longest time, and basically outperform the market. So I'm finding these companies and basically going there and really finding them. So when I started finding that route and finding the multibaggers, that's really what we did. So when it really go back into that whole thing of basically finding multibaggers and really just says, okay, I need to find companies that are non-stop compounding massively over the years, and ultimately these are the ones that generate the return. And that kind of really just leads back into the whole investing philosophy of how I'm investing.
Great. I have a follow-up to that. Based on your method, you said, right, about finding, is literally flipping seashells on the seashore, very big seashore, right? How often, maybe just a ballpark figure, that you flip 10 and you don't even find one, or you flip 10, you find one, that it's potentially a multi-bagger that's on that right side of that tail, What's your ratio like?
Yeah, to give you an example, right? So I mean, obviously last year was a very abnormal year. So I actually own almost more than 80 stocks in Vision Capital. Okay. So I'm not a concentrated investor. I don't believe in. I mean, for me, I don't hold more less than 5. I think one needs to hold at least more than 20 to 25 stocks. Sure. I actually hold 80 stocks, right? And in last year, more than 80% of my companies that I invested in beat the market.
Oh,
wow.
So there's 64 companies out of more than 80 beat the market, right? I mean, if you can think about it, is it a coincidence? I would say, it's up to one to determine, but I would say the majority actually beat the market. And what happens is that, to give you an example, right? the single stock that generated so much returns, actually, if I remember the number, was more than about 20 times all my losses of all my losers combined.
Wow.
One single stock, right? And the single stock was almost, I think, a 15-bagger for me, basically. Yeah, and of course, if I total up all the gains from all my stocks, right, they actually basically more than wipe out all the losses. Because the way you think about it is again, it's back to mathematics.
Yeah.
The maximum a stock can always go down is minus 100%.
Correct.
But can it really go down to minus 100%? Right? Generally, unless the company really goes bankrupt, most of the time it's probably 50-70%. Now, the math of finding a stock, when a stock can go up 100, 1x, 2x, 5x, 10x, that math alone. So if you get a lot of companies that grow up 5x, 10x, 20x, 50x, and you have a maximum of just the minus 1x, your average of all of that actually beats the market. So it's really a mathematical equation that I'm thinking about it. If I can find enough multi-baggers, let the winners run, these winners will basically more than offset all of my losers. And the way to think about it is that I think generally on average on any given year, I would expect, say, if I'm hoping, sometimes it's about, say, between 50 to 70% of I expect my companies to kind of, or my investments to kind of beat the market on an individual company level. But it really depends because, I don't know what's going to happen, today, tomorrow, next week, next month, next quarter, or even this year, right? But I think over the long run, I'm confident as I'm investing in businesses, just leads back that way.
I see.
So if I'm doing it that way, naturally the math would just gravitate and you just kind of outperform and beat the market.
Right.
Yeah. Maybe I angle it towards more the retail investor because would you agree with me that research, especially stock research, is always almost like a full-time job? It is a full-time job, right? And for the retail investor who does not have that kind of luxury of flipping those rocks, right? With your approach of many, many stocks, which is like 80 stocks, right? They would argue, why bother doing active investing but put my money into an ETF? What's your opinion?
Or stash away.
Yeah, stash away. What would be your opinion towards that in a way? Because they said, why bother when this guy is so diversified? I might as well just go and buy an ETF, pay much lower fees, right? And yet the odds of generating returns are obviously you beat the market, but their argument will be from that point. What would you say to that actually?
Yeah, I think Warren Buffett has a very valid point because if you look at most fund managers, the majority of the fund managers, between 80 to 90%, they can't beat the market. They can't beat the respective benchmarks over 5-10 years. It is a proven fact. I mean, you can see the numbers. Many studies have that, right? So when Warren Buffett basically had the point of investing in, or John Bogle basically investing in ETFs, it made a lot of sense. You do an ETF, you have low costs. Rather than high cost, mutual funds, that kind of erodes all the returns. So I think for the average investor, it really makes a lot of sense. But where I come from, I think, for us, we are in a world where there's technology. I think that's where we can actually help to change the world. And that's why it ties back into vision capital and vision investing, because ultimately I want to be investing in companies that are really the future, changing the world. And so basically you are actually voting with your own money. You're voting for the companies with your own money. You are part business shareholders in these businesses, right? And that is so much better. You actually learn a lot more. I did give you an example, right? When I first started in my very first year, I probably only had 5 stocks back in 2017.
Concentrated portfolio.
Concentrated because I made a point that wherever I finish. Whenever I invest in a stock, I have to write between a 40 to 80 page investment thesis.
Oh, okay.
So I write that and I know everything about my stock, right? So that helps me. So to give an example, right? Just now you say about time. When I first invested the first company that I actually invested was in Facebook. It took me almost close to 1 month.
Wow.
Double weekends. Every weekend was 12-hour days.
Wow.
Reading the 10K, the annual report from cover to cover, every single word, every single paragraph, understanding everything about the company. But the good thing is that once you do that from cover to cover, I think you remember it's like, I don't know, it's like 200, 300, 400 pages. And after a while, you realize you know what to look for. You read the second one, right? My second one that I actually invested in was actually Alphabet.
Google, right?
Or Google, right? And the time actually got halved. Because I knew where to look for. Because a lot of the sections you actually don't need to read, right? And you started looking for, right? And then the next one was like Amazon.
You said, you know what
he
you
got
said?
half.
You said Alphabet at Google. My Android woke up. Sorry, just go ahead.
No problem. Yeah, so he went to Amazon, and then after that, the amount of time just got shortened and shortened. So actually, what happens is that the time of which you spend looking at companies, right, actually becomes exponentially drops. So like for example, right now, I actually take on average between, I would say, 4 hours to maybe 10, 15, 20 hours, depending on the company and the complexity, when I'm reading a company and doing my research. So it is, I would say that it's really a lifelong journey, because to be investing, you're really understanding a lot of how the world is moving and how the world is shifting and how the world is changing. And that's great, right? Because you get to be happier, you get to be richer, and you get to be smarter. Yeah, which is, the Motley Fool's motto as well. And I'm really, I think that's a way to go. As investors, we should be not just passive investors. Right. I think money shouldn't be just passive, I think we should be voting with our money. And I really think that the average retail investor has all it takes to beat the best fund managers in the world.
Great.
Right. And of course, that's why you wrote the book.
Exactly.
Right.
Exactly.
Sorry to interrupt this podcast. I know it's a little bit annoying, but I want to tell you something that I think can be really helpful to you. I can tell you're really interested in the stock market and want to learn more about it so that you actually know what you're doing, especially when today things are getting more complex and complicated. That's why we came up with the Stock Investing Blueprint, or SIB. It's our signature e-learning program that teaches you how to pick the right stocks most of the time, buy and sell it at the best possible time, and manage your stock portfolio systematically. It currently has more than 10 hours of content, and it's growing. You'll also be part of a group of like-minded investors that can help speed up your learning process. To hop on the program, click on the link in the description or go to learn.firl.co/courses/SIB. Okay, so thanks for sharing that way of thinking about active versus passive investing. I think that's the first time I heard of it. I mean, for us, we do active investing somewhat similarly. Like it's because it's just fun, right? Like,
it's a game for us.
Actually, it's not just about making money, right?
Yeah.
But okay, so now we've talked about passive versus active. So let's zoom into active a bit, right? For most active investors, I think the big challenge, right, even regardless of experience, is to generate ideas, to discover potentials. So what is your process like for finding the next multi-bagger? Like, how do you come into contact with them in the first place? Don't talk about assessing the management and all that first, right? How do you even discover these kind of opportunities?
This actually was a very interesting thing. So when I first started my investing journey, what I did was, I think the course that I attended told me screens, right? Okay, you should find revenues, growing, profit margins, this minimum profit margins,
PG, PB,
cash flow, price book,
ROE must be more than 15%.
Yeah, exactly right. All those screens, right? And the funny thing was that when I actually did a global screen, I actually struggled to find companies to invest in Singapore. There were only at most really a handful companies that I thought could do well, and I really struggled. Right. So, and then I started looking, okay, is there anywhere else in Asia? And then I realized, I also struggled. So actually what happens was that I actually started shifting to the US. I think the Motley Fool is a great resource because they have a lot of companies, but I think it's very important because when you're looking at all these companies, right, you got to be really thinking, okay, trying to understand the business. What are they trying to do? What is the problem they're trying to solve? What is the good thing that they're trying to deliver? Is the business model sustainable? Is it recurring? Is it growing? What is the market opportunity that is really against? And really just coming up from there.
I see.
Yeah, I think really going from there, I think that really was just the big. So when I started finding, for example, my first on Facebook, right? Facebook was in the space of social media, right?
Yeah.
It's actually not a social media company. It's actually an advertising company.
That's right.
Correct.
And if you think about it, we had the whole world of advertising because it was inefficient. It was inefficient because people didn't measure it. Advertisers couldn't measure the ROI. You couldn't know if I had spent this amount of money, how many people was going to have click-throughs, how many people would I have reached, and how many people would have clicked through to buy my product. But the Facebook actually changed it because I could now do an end-to-end. And I know if I spend $10, I can generate $100. I can spend, I can generate $1,000. I know exactly how much ROI that I'm going to get. And that fundamentally changed the world. And when I look at the total advertising market is here, and Facebook and social media, or what you call it, advertising was only this small chunk, that fundamentally changed my world. And it's like, okay, it has been growing, and I think it can continue to grow. And that's one way to think about it. So it actually fundamentally changed in the sense, small versus big, what's the market opportunity? And that's where I started thinking, okay, I need to look for companies that are addressing big market opportunities.
Okay, so you mentioned a very key word there, which is addressing market, but you didn't say the exact word. And I know it is in your tweet, what do you call it? I don't know, your links, which is a total addressable market.
TAM.
And I know that's a very important aspect or step in terms of your process for finding the next multibagger, right?
Yes.
So we actually run a course that also talks about total addressable market, right? So we know exactly why it's important, but that's just our thoughts, right? So from your perspective, number one, why is total addressable market important? Number two, how do you actually go about finding it? Because I know, having guided people to find total addressable market for various industries, it's not exactly an easy thing.
Yeah.
So what are your thoughts on that?
Yeah, so I think total addressable market is important because to give it a context, right? I can be a great company having 80% market share. I'm the monopoly, right? But I'm doing a very niche product in a very niche market, right? And if I'm already 80% monopoly, 80% market share, and the market, is not growing, is stagnant, eventually what will happen? Revenues will be flat.
Yeah.
If revenues will be flat, cash flows, profits will be flat. If cash flows and profits will be flat, the stock price will either be straight or down at some point in time. So that's one way to think about it. Now, if I have a company that's growing massively, gaining market share, delighting customers are really happy, right? Delighting users. And they're addressing a very large market. So I'm thinking about small addressing a very big. This can become so big. And the good thing about market opportunities is it doesn't happen in a day. It often takes years or decades to occur, right? I mean, you look at, for example, just e-commerce alone, right? To get to, in the US, right, e-commerce is like 14%. It took us, Amazon started 1997 or even way before that, right? It's almost 20 plus years?
Yes, 20 plus years.
20 plus years to get up to 14%, right?
A fully grown adult.
Yeah, you think it's fully grown. I don't think it's fully grown because I think, I suspect anywhere, we will probably be doing like 50 to 70% of our retail spend is probably e-commerce. So I mean, I think it's such a long runway to grow, and I think that's a very different. So when I look at TAM, it helps me to guide me to think how big the company can be, because we're looking for multi-baggers here, right?
Yeah.
So if the bigger the company can potentially be, the greater the opportunity.
Yeah.
Of course, you want a company to deliver and stuff. Now, the question I think you had about how do I find TAM?
Yeah.
The best resource is Google. Right? I mean, it's really right. You find Facebook, you find, advertising. Search total advertising market, right? And you start coming reports, right? They'll start coming, Gartner will publish, various industry will publish. I generally try to find like non-industry reports to give me a sense of what that TAM is, of the total, or find, for example, what's global advertising market, right? Of, in the whole entire world. And then I find, what's the social media aspect of it? What is it versus display? What is it versus, search? What is it versus print? What is it versus, other various forms? Yeah. And I look at what's the trend. Because trends are important, because trends tell you the direction. You won't tell you exactly, I don't really care about the 0.1% or 0.2%. I care about a bigger trend. If the trend is right, so I'm looking really for tailwinds. Tailwinds are driving the direction towards the large market opportunity, and that helps me to give me. So if I have a tailwind, right? Tailwind is here. The company is just going up here. Yeah. It's just riding along, right? And the company can be performing even better than the tailwind and gaining market share. Wow, those are just the companies you just want to own.
Great. All right, I can see your excitement. Do you have a question?
Yeah, I do. With regards to the Googling part, because what MJ and I sometimes struggle is that while we can find this on Google, some of these numbers are actually based on very expensive paid reports. I don't know whether it's the same for you. In a way, it is not publicly free and available. Do you have any resources that you pay or subscribe to get this kind of insights? And the reason why I ask is in the wider context of the audience, because we have some of our students that say, getting financial data, share investor, they can't even conjure up paying 50 ringgit for it. What more to say? More expensive industry.
Either because they cannot afford it or because they're just kiam lah.
They're very kiam, kiam lah. Right? So in your space, do you subscribe to certain resources that you can't find publicly, and then is it worth it for the retail investor to actually adopt those methods?
Yeah, actually, the short answer to it is no. The way actually another way I find TAMs or total addressable markets is really looking at the company's annual reports. One of the best ways, actually, if the company is just starting public, typically it's found in the S1 or what we call the IPO prospectus.
Yeah.
This this is SEC terminology,
SEC,
right?
SEC filing, correct. SEC in the US, you call it S1. Of course, the specs now, you have a different name for it.
Yeah.
In Hong Kong, you have IPOs prospectus as well. The great thing about IPOs prospectus is typically what they will do is that they will kind of find out the market opportunity. They actually size up the market opportunity for you. They'll tell you this amount of users and this amount of people, and they will get an independent consultant to find out those numbers. So I would say the annual reports and the 10K are generally just great resources because it helps to guide you, right? When a company is sizing the total addressable market, they will actually break it down. Okay, I'm looking at this industry, how much is it growing prior? How much do we expect to grow in the next 3 to 5 years? Directionally, you're really getting it there. So I think I usually actually use companies' annual reports as a starting base because it helps to kind of get me a sense. I won't put it with it 100%, right? Because obviously sometimes the numbers can be overly optimistic.
Yeah.
I'm more important. Okay, is it a 5 billion TAM or is it a 100 billion TAM?
Yeah.
Right. I'm looking at, okay, then is the growth 20% growth or 2% growth? I'm thinking really more directionally, more magnitude rather than the absolute number.
Understand.
Because to me, 2% or 4%, there's no big difference.
Yeah, doesn't move the needle.
It doesn't move a needle, right? But if there's a CAGR of a compound annual growth rate of 20 to 25% or even 40%, that is different, right? So I think company annual reports actually help a lot to just provide good resources for us to just look at.
Fantastic. Yeah. We struggle in the Malaysian market because we can't find a lot of prospectus for any companies listed before 2005 actually. Yeah.
So anyway, that's our problem. But I can see your excitement when you talk about TAM, right? So here's what we're excited about.
Yeah.
We're excited to know right now what are your top 5 areas with the biggest and fastest growing TAM right now that you're looking at?
If I look at it, there's a couple of ones. I mean, the first one I'll think about it really, it's electric vehicles.
Oh, wow.
Oh, EV, okay.
EVs, right? I think if I look at it, why do we have electric vehicles? We have electric vehicles is because we have actually, all the countries in the world, governments have all agreed to lower carbon emissions. And if you think about it from the global carbon emissions pie, transport and transport actually accounts for, I would say, almost close to 1/3 of it.
Yeah.
And there's certain things you can't remove global emissions, right? And transport being the easiest way because we are using oil. Oil generates petrol. Oil, generates fumes and CO2 and stuff. So the biggest way is to change that part of that, and make it renewable. Now, so what happens is that if you look at it right now, there's 2 things. We have what we call ICE, the internal combustion engine. And then what you have called electric vehicles, right? Of course, electric vehicles depends on your electric source, right? In China right now, it could be more coal-based, but in the US, it can be more gas-based, more LNG-based. Of course, in different countries, it does vary. But I think in China, for example, they are actually reducing coal. So that trend, that direction actually is moving in the right direction. So it will be more renewable. China will be more renewable. It's a matter of time.
Okay.
Now, the way to think about it is you have these 2 lines. This is the internal combustion engine. It's going to go down like an S curve.
Okay.
And you have actually electric vehicles going up in the S curve from that standpoint. Okay. So you have actually 2 curves crossing so you actually have two curves crossing at some stage, right?
Yeah.
You actually go back. And in this case, what happens is that I would say, right, in the next 20 to 40 years, you probably will not see an internal combustion engine car in the future.
Okay.
Wow.
The majority of our cars will actually be electric because all the governments have already agreed. You can see everyone is saying by 2030, by 2025, or for example, or by 2035, all vehicles have to be electric. So the world is going electric. Now, if I'll give you an example of the TAM, right? If I remember the annual amount, the total global stock of cars is about 100 million, give or so, plus minus 10 million or so, right? So just assume 100 million, right? And on average, a car lasts about 10 years. So let's do some market sizing or some TAM right now, right? So if you think about it, on average, a car is 10 years, cost of a car, let's make it simple, 30,000. That TAM is what, 3 trillion?
Wow.
Right? So on average, you take 10 million, you times 30,000 is 3 trillion. So Tesla, for example, operates in a 3 trillion TAM. Tesla doesn't tell you that its TAM is 3 trillion, but the global automobile TAM is 3 trillion. And 3 trillion TAM is larger than any e-commerce TAM. And in the US, they're probably in 80 or 90% market share of all EVs. They're right now taking a very large share in China. You don't have to be there all around the world to take market share. Right? They just have to be in the largest markets in the US, in China, in Europe, in Japan, and some other markets. Because the way you always think about it is, you just need to attack the 20% and you get an 80%, right? I don't need to be in India, I don't need to be in Singapore, because it is structurally very difficult. But I have my strength base in the US, I have my strength base in China, and that's enough. So the way I think about it is because the TAM is so big, and because we just don't see it, because it takes so long. Everyone buys a car takes 10 years, right? And you don't feel it. So you think, in the short term, Tesla's price is expensive. But you don't realize that it's actually changing. It's actually changing that. And I think about it, transport is changing because one, it's actually going to be renewable. It's really going to be cleaner. And the good thing about EVs is that you really have to have autonomous. And the good thing about autonomous is it's actually safer. If you look at the number of accidents in autonomous, right, it's actually much safer than humans. So when you're driving a car, accidents happen because we humans fall asleep or we tend to do stupid things and we have accidents. And if you think about it, if every car is autonomous, it follows the line. There'll be no accidents. The only accidents is when suddenly one gangster takes over the car and drive, and suddenly all the other cars don't know how to react, right? And then you have an accident. Or somebody hacks it or along those lines where you kind of watch it in movies. And the even bigger thing about that is actually like robo-taxis, for example, for Tesla. So they actually, so Elon Musk actually said this to Katie Wood of ARK during an interview. Because Tesla has so many cars on the road already, and they've been recording real life miles. The number of miles they have actually recorded is 100x all of their competitors combined.
Wow.
And just imagine, Tesla has more cars on the road out there, right? Where most cars are still in the campus. Right? And so if you think about it, Tesla's miles is just exponentially up, and the rest are just like that. No? You know what I'm trying to say?
Yes.
So they have their machine learning. So and because it's vision based versus lidar based, they just have just amazing advantage. And when you have that, right, autonomous is good. I think autonomous cars is just going to be a future. And that drives. So when you think about it, autonomous. So to give an example of just add a bit of robo taxis, right? When you have robo taxis, Tesla is looking at a 1/3 take rate. So it means, for example, of $100, Tesla takes $33. The technology has already been developed now. Correct? In the future, basically what happens is that we are actually the taxi driver owner. We own the taxis. We have an app. Let me paint you a story, right? I have a Tesla car.
Okay.
In the morning, I go to work. The Tesla basically picks me up, sends me to work. I can check my emails, clear my emails along that. Comes back home. The car drives back home on its own, fetches the wife and the kids and sends them to school. And then after that, goes and be a robo-taxi for 8 hours. Earning money. A car, this has fundamentally changed because a car is no longer a liability, a depreciating asset, but it's actually not a depreciating asset, but it's actually now a real asset generating cash flows.
Wow.
If you think about it, Elon Musk basically paints it, right? The NPV of a Tesla is actually 250K. And if it only costs 30 or 50K, it makes no brainer for you to buy a Tesla. Why would you buy anything else?
Okay.
And And when you do that, that fundamentally changes, right? So when you do robo-taxis, if 30% take rate, as the number of cars go up there, right, their cash flows just skyrocket. That's the true potential. The true potential, what they're trying to build is to build this base where you're all actually sponsoring their cars and buying their cars.
Actually,
right? You're actually sponsoring their infrastructure. Yeah, and that is something that we don't see yet, but when it becomes so apparent and you realize, oh my god, that it becomes a fully autonomous robotaxi.
Great. Actually, what I wanted to add was car park owners beware. You don't need car parks anymore.
You don't need car parks.
Yeah, because
thank God, man.
Yeah, because it's like in major cities, based on the scenarios you describe, most families, especially when they have children, the wife will have a car, the husband will have a car. And the cars are actually not doing anything during the 8 hours that they are either in the office or it's being shuttled around with the kids and all that. So, wow.
Right.
Exactly. I think you're spot on because what happens is that I think we end up having lesser cars.
Yeah.
And we don't need car parks. And in urban, we actually don't need all the car parks and we can actually have more buildings. We can have more greenery. Yeah. I think it will fundamentally change the urban landscape, I suspect, in the next 20 to 40 years.
So based on what you described, I can I make a safe assumption they are very, very bullish on Tesla?
Let me put it this way, right? I think we are going to move to electric. I think Tesla has specific competitive advantages. It is one of the largest positions in my portfolio, but it got there because of its own merit. Right? It's been a multibagger for me just because of its own merit.
Understand.
But it was a very difficult stock to hold. I own it since back 2017.
Oh.
And in 2017, 2018, everyone was talking about Elon Musk. He was going through all of those, right? But that's the thing about when you're investing in companies, you read books. So what changed me was when I was reading Elon Musk's biography.
Yeah.
And when you read his childhood, right, he actually had a bit of a tormented childhood in the sense that he was this kid from South Africa and he was constantly bullied. But because when you read that in his book, he had that grit, that determination to make something happen. This is the guy when he talks, when he says a number, right? It's not a goal, no. It's like a dream. He wants to make it happen. So when Elon Musk says something, right, it's not like say an analyst in a typical CEO in a company. Okay, I say this. Typically, I'm actually lowballing, but most likely I'll outperform, basically, right? But Elon Musk is really aiming something very high, so high that it's so difficult, and even just reaching just slightly below, it's just out of the world. So that's the way I would think about how he thinks about numbers. And when if you think about it day one, right? He said this: I'll make a sports car, a very expensive car, people will buy. I'll make a slightly less expensive car, more people will buy, and then I'll make a more common car where everyone can buy. And then I'll have renewable and I'll have everything else. And he's been doing exactly what he said. He has never deviated, right? And Tesla, if you think about it, has been over what? He's been around for what? More than 10, 15 years already?
Yeah.
And people are still being skeptical. I mean, when I was in the US, for example, just in San Francisco, just actually before COVID, and I was there in person. I think that was when the Model 3 rolled out. About 4 cars on the road was a Tesla. I was like, oh wow. And of course, I was in Silicon Valley. I was doing a Silicon Valley tour, and I was doing a real life, and someone was there just summoning the car out from the car park. He was there holding his iPhone, pressed. The Tesla came from the car park and came to him. Wow. And then we were on the road. He said, "We're going to go into basically into auto drive."
Okay.
He said, we're going to turn it on. I'm going to be on my Google Map. I press the screen of our next destination. Let go. He was hands off, legs off, and we're basically on the highway.
Wow.
And I could feel it. The good thing I could feel it because it was vision-based. Vision-based is very different from LiDAR. When you notice something, it gets there and you can sense. So for example, when a car was coming from the side, the car was like going out but not going out. You could actually feel. So when you have vision, it actually ends up driving like a human. Yeah, so I was like, wow, there's some intelligence behind it.
Yeah.
So when I actually felt it, I was like, wow, the future really is here.
Yeah.
It's not evenly distributed yet.
Okay. Why do you think adoption is slower here in somewhat? Is it because of cost?
I think it's cost. Cost is one. I think really infrastructure, because if you had to have solar and have a charging station, you probably need to stay in a house or in a landed property, not like stay in a flat or in a condominium. So I think in the US, a lot of people actually stay in houses. So when you have houses, I can basically have solar cells. I have batteries that charge the solar cells. Actually, what happens is that a lot of these have solar cells and they end up charging the battery. And what happens is that because they generate so much electricity, they actually contribute electricity back into the network. So a lot of the houses actually become mini power stations, which is like, wow. I'm actually, instead of carbon negative, I'm carbon positive from that angle.
I see.
Yeah. So to me, it's like it fundamentally changes the entire dynamics.
Great.
All right. Yeah. So I think you share a lot about electric vehicles, and I get the sense that you can go on and on about this. But we want, what's another one? What's another industry that has this sort of potential, or at least close to it?
Huge time.
Yeah, I mean, I would have two, right? I think e-commerce and payments.
Okay.
Electronic payments in the sense, you think about it. Okay, I think let's go electronic payments. It's probably the easiest, right? We have the war on cash. Cash is inefficient. We have notes. I think right now, if you think about it, I think about 15 to 20% of the entire world's payments is still being made using hard money, right? I think all money should be paid digitally.
Agree.
And it's just you can only grow with that.
Yeah.
And of course, there are great companies along that would support that. I think like you have your credit card companies that form the base. You have a lot of online payment companies with likes of PayPal, Square, Adyen, all this that all support all of this. I think so. It's a war on cash, right? And then the war on cash is making it easier for us to all do it. And it's such a big TAM because payments is another large TAM that is just so massively big. That runway, for example, for Visa and MasterCard is just like a toll booth stop. It will just keep running around.
Yeah.
For growth. And of course, the other one that you wanted to share was like probably e-commerce, like I mentioned just now. You look at China, e-commerce is probably like 30+%, Korea 20+%, rest of Asia 10-ish%. Right? I think the world is probably going to be, I suspect it's probably going to be between 50 to 70% of our spend is going to be on true e-commerce.
By?
I don't know, 10, 15, 20, 25 years.
Okay.
I mean, I like to think about in probabilities in
sure.
Yeah.
Yes.
Okay, so e-payments and
e-commerce. Yes.
So of course, I think one of the big challenges where you mentioned these three areas that are growing a lot, and I think investors who are a little bit more sophisticated, they'll at this point, right? Okay, time is great, it's growing, the future is bright, right? The future is here. The challenge then for active investors is, remember, you're not buying a TAM, you're buying a stock. Right? Because even if the TAM is great, that doesn't mean that you can profit from it, right? I think Buffett uses the example a lot in the past of, ICE or internal combustion engines, the cars, the helicopters, the planes, and then, of course, more recently, the internet. All four of these technologies was, for their time, revolutionary with big TAMs, right? Yes. Yet, if you would invest in most of these companies within these four big industries, you will have lost money, right? In fact, he lost a lot of money, still continues to lose money for some reason in airlines, right?
Yeah.
So, moving away from the TAM discussion now, when it comes to stock selection, how do you pick the men from the boys?
I think you pointed out a really good question. It's a really good segue into the next part, right? I think when you look at businesses, you really got to look at what is the business model, how are they making money, and fundamentally, when understanding that, really, I think that gives you a sense, right? When I think about businesses, right? So I give an example, right? Now, there's one business I generally don't like to invest in, which is F&B businesses. Now, why F&B businesses, right? So you think about F&B businesses, I typically have rent. I have to pay rent. I will have to have hire workers who is going to be there on a monthly cost as well. So there's going to be those costs. But if you think about it more importantly, right? For an F&B business to make money, typically the occupancy rate has to be between, I'll say, 80 to 100%. Okay? And if 80 to 100%, they make this amount of profit. But if COVID hits, the profits go to zero. Now you think about it from a risk to reward standpoint, right? Business is great, everything is great. I made this amount of profit. There's limited upside. But when something goes wrong, there's unlimited downside. I don't like to be investing in businesses that have unlimited downside and limited upside. So that's one way. So if I think about it like airlines as well, right? Airlines have to be basically at 70 to 80 to 90% occupancy for you to generate this amount of profits. And if something happens, like now, they end up bleeding a lot of cash.
Right.
So that's how I kind of really think about the business model. And that helps me because I should know F&B I won't invest, airlines I won't invest, and a lot of companies and industries I won't invest. And it actually helps me to, that is a way to just eradicate, kind of eliminate a lot of the industries and specific companies. So I'm really looking at, okay, I love companies that way, to put it this way, right? When the revenue grows, the profits and the cash flows grow even faster. That is the magic nirvana of finding that great stock, which truly will compound and outperform.
Do you have an example of?
Yeah. I mean, to give you an example, right? So let's look at Zoom, right? We're all using Zoom right now, right?
Yeah.
When you look at Zoom, when it first started, when you look at its IPO numbers, right? It already had operating leverage. What does it mean by operating leverage, right? So operating leverage, Zoom has spent a lot of technology, a lot of money developing R&D, creating their platform. What is the real variable output or input that it requires suddenly? If I 10x the amount of users into the platform, the only true cost is the hosting cost.
Yeah.
Correct? If your technology was truly scalable, all you truly need is your hosting cost.
Yeah.
Right? And that's why Zoom could easily scale so much. So you look at their last 1 year of earnings, literally when they 10x, or when they had so much growth in their subscriber, right? Their revenue just went so much up higher. Their profits and cash flows just grew even faster than their revenues.
Yeah.
Right. And that's what happened to the stock price. The stock price happened not because revenues grew, because profits and cash flows grew.
Yeah.
And that's an example, right? Where I say, if I throw suddenly that amount of people into the platform and suddenly that amount of growth, those profits just fly through the roof. And those are the kind of businesses that I really, really love. Sure. Yeah, I mean, so that's one example I would.
Yeah.
Okay, so getting back to our the discussion about how do you pick the man from the boys, right? So you've described how you would eliminate certain industries based on the upside downside equation, the risk reward ratio. So maybe to be a bit more concrete in my question, what I would ask you is, let's say e-payment systems or e-commerce, right? We know the TAM is growing. In fact, you don't even need to run any math. You can just ask my mom, who runs an F&B business. She knows exactly what you're talking about without knowing the numbers in terms of e-commerce and e-payments. So my question is specific for companies operate or industries that have good TAM and is growing well. How do you separate within this already? They're good already, the company, but there are hundreds of companies in the space, right? And even in the case of electric vehicles, right? Nobody would say that there's going to be a cap on how many entrants into the market that there will be. How do you say, okay, Tesla's going to win, or Square is going to win, or Mercado Libre is going to win, whatever it is? How do you differentiate?
Let's look at an example, right? I think of a platform. So I think two things, right? I like businesses that are really, I would say, platforms or marketplaces. The good thing about businesses with platforms or marketplaces, it's you have a very powerful competitive advantage. And the powerful competitive advantage is network effects and economies of scale. The good thing about network effects is when I have someone added, I have one user and I have two users, that compounds.
Yeah.
The power of the network just keeps compounding, right? So to give you an example, right, of Mercado Libre, when I have more sellers, more buyers will come.
Yeah.
If more buyers come, more sellers will come.
The feedback loop.
The feedback loop, right? You have a flywheel. And that's exactly what it is. And when I like businesses who have that feedback loop, I would call it that flywheel, the continuous flywheel that just keeps growing on its own without. So when I look at businesses, right, going back to that, right, is the business fundamentally going to be very strong? And you can get signs. So I can see our customers being delighted, our customers using. Is our MAUs growing, right? Which is monthly average users, right? Are people spending more? So I look at a lot of indicators of every single business to see, Are the customers liking it? Are they using it more? As a result, and then revenues is only but an effect, a consequence of that.
Yes,
right? And that shows, right? And then after that, I'm looking at again next at the business model. How are they making money? Are they taking a cut, right? If for example, if on the Mercado Libre platform, which is Latin America's Amazon, if you right?
Yep.
If I have more, if the way we call it, like basically what we call GMV, gross merchandise value, value, the more people spend on the platform, if they take a fixed percentage cut, they make more profit.
Right.
And just imagine they operate the same amount of fixed costs.
Yeah, that's right.
Right. If the revenues go up, the profits go up. It's a no-brainer that the profit margins.
Would this be where you introduce the idea of scale? Is scale what you're describing here?
Exactly now, correct. So now when I think about it, then it comes into skill and operating leverage, where I know there's a particular fixed base and it scales it. So I'm really looking at business models and ultimately I'm trying to understand their cost structure. And the cost structure is so important because the cost structure actually tells me how much of it is variable, how much of it is fixed. And importantly, I'm always going back to see, okay, how sustainable or what is the moat of that business? Does it really have that moat to continuously keep growing?
Yeah. Just to add on to, a question to that point, do you think management is important to differentiate between the men and the boys? And here I come from an angle where I'm a fervent shareholder of MasterCard. I've been holding it since 2014. Okay. And now there's a change of guard because RJ just stepped down, right? But he's still, So from your experience and from your sampling, right? Plus, let's just say both companies have, let's say A and B, company A and B, both have potential of a big time, potential of scalability. And in your experience, does management play a very key role in businesses of this nature, this type actually?
I think you brought a really good point there. Because ultimately when you're investing in businesses, right, they're all run by people. Yeah. All running by people, you're actually investing in people. Yeah. Right? Yeah. Now, obviously we can say that a company is really big and the company is really big, the average incremental person will not move the company. Now, when I think about management, I think about it really about two things. When I look at companies that I invest in, they really typically fall into two buckets. The first bucket is they're founder-led, founder-owned, and they tend to have large insider ownerships. Typically with very high Glassdoor ratings. So I use Glassdoor as a platform to tell me whether they have what we call CEO approval ratings. And typically also people will rate them, so that number of stars. I try to find at least 3.5 stars and above. Typically, I would look for CEO approval ratings of, I'll say 60%, 65% and higher. Which tells me that employees enjoy working for their CEO, enjoy working for their management. That helps me to give me a sense. Management is so important. Also, I typically look for founder-led, founder-owned. But of course, like you said, right? Example. So it brings down to the second example, like for MasterCard. Yeah. These companies are around for so long, right? Yeah. And when MasterCard, it was not created from a founder-led company, right? Yes. It was created from banks. Correct. Now, if you think about it from the sense, they have professional management. So this is the other segue. I look for very strong professional management with a very strong infrastructure of managers who are also, managing the business very well. And they have displayed history, right? They've displayed many years of constantly showing me that they have. Yeah, I think that's just really key. And one tip that I usually look at when I look at founders and management, right? I love watching videos. I love watching YouTube videos. What I typically do is that, okay, if I find, for example, one particular founder, right? So maybe I look at Toby Luque of Shopify. Yeah. What I'll do is I'll go into YouTube, I'll find Toby Luque Shopify, comma interview. I like to look for interviews, and I look for interviews where typically when the interviewer is asking is really asking childhood questions. Why questions? Why do you do this? Why do you do that? What happened? That kind of questions. Now, when they answer those kind of questions, it gives you insight into who that person is. Why are they doing what they're doing? And when you look at not just the way and the passion that comes through into the lens, you hear their voice, you hear the tonality of the voice, you look at their body language, right? It says so much things, and that helps you to also tell me, what is this founder like? And I don't do that over just one video. I typically watch 2 or 3. Wow. Give me a sense whether is it consistent or not. Because sometimes, they can be really good, right? You can be trained. Yeah. And that really helps. So I find that when you start noticing patterns. When someone says something, but somehow maybe when they ask a question, their answer changes slightly.
Does not jive.
Does not jive.
Yeah.
You can sense something. And then when you listen to another interview, that gets again, you sense something. So I'm always looking for patterns, right? Investing is about really looking for patterns. I'm looking for patterns I love people who have a lot of determination, a lot of grit. They wanted to do something. And that's ultimately what drives. So I'm always looking for that special, I would say, sweet spot or special secret sauce.
Understand. You need to differentiate the Adam Newman's, what's the Toronto CEO's name?
Elizabeth Holmes.
Elizabeth Holmes against the real.
Yeah, sometimes it's a fine line, right?
Yeah, it's a very fine line, you know.
They know the right words to use, right?
Yeah.
To
right voice tonality.
To invoke the emotion among the investors.
Yeah.
So it's really an hour long, and we can go on for a very long time, and we do have a lot more questions actually. And so you shared a little bit about management. I just want to add on to this, right? Because what's very interesting for a lot of people who are global investors is they always draw this distinction between managers in the West and managers in the East.
Yeah.
And so the typical argument I say that I hear is, in the West, there's a lot more professionally run companies, whereas in Asia, definitely in Malaysia and Singapore, a lot of it is founder-led, and the founders actually own a lot of it. This is true for Asia, and it's family-run, right? That's the word they always use.
Yeah.
And they use that term a bit disparagingly because what they're trying to imply is that, that it's non-professional, and these are just people who kind of like, because they own so much, they can do whatever they want with the company. But what I'm hearing from you is that actually when you invest in the West, because that's where most of your investments are, you're actually looking for the characteristics that are more present in Asian companies, which is
founder-led
and high ownership, right?
Insider ownership. Yeah.
So, I guess my question is, isn't there a risk, right? To take the other side, isn't there a risk that because it's owner-led, then they are likely to mess with minority shareholders?
I think the way to think about it is, the way to mess typically with minority shareholders, you look at dilution. If a company is constantly raising or selling stock to raise for capital, constantly burning profits, and the profits margins, for example, not rising, constantly raising. I think that fundamentally changes the way I see things are. So I think I use dilution as a way versus share price, and of course, if the share price, the revenues are not growing as fast as what dilution is, it's a problem. So I'm okay with dilution. I'm okay with people selling stock, companies selling stock to raise. If the stock price rises faster than dilution, I have no issues.
Okay.
Right? If the company is growing faster than that, I have perfectly no issues. But I think really going back to that, fundamentally, I think management, it is really an art. I wouldn't say that, it's easy. Let me give an example, right? So one of my biggest losers was Wirecard.
Oh,
okay.
Okay.
So I had Wirecard, but I was one of probably my 10th or my 15th investment. I can't recall.
Okay.
So when I bought Wirecard, it was probably 2018 or so, or 2017 even. Great payments company, right? Story, right? So I finished my thesis, and that's an interesting thing. When I wrote my thesis, I wrote there were a lot of cross-company investments. So something was there. Clearly, it was a red flag, but at that point in time, I didn't have that the knowledge or that wisdom, right?
Yeah.
to find that these are red flags and you should flag it out, right?
Yeah.
So I just put it aside. So when the first FT report came about, that Wirecard basically was, masquerading their revenues, a lot of circular payments, and that's where something was wrong. So what I did was actually I went to the Wirecard, I went to all the subsidiaries, I went to find out all the companies, and I looked at the financials, and they were a mess. And with that, immediately I exited the portfolio. Now, what happens was that was also at the time when I didn't actually watch the video of Marcus Braun. Now, what happens was that at that point, I actually went to watch Marcus Braun CEO. So if you find Google Marcus Braun CEO interview, there was one interview where he was being interviewed on stage, like 2 person on stage sitting down, and his posture of his hands was like that, and his face was too back up.
Oh, interesting.
Interesting, right?
Yeah, very
so
interesting.
The way you're talking was, high up, and that was, wow, that was a big red flag, right?
Very aloof.
Very aloof, right? Thinking I'm great, and I'm ruling the world, and it gives off that kind of impression. And I think when he had that made me realize that I needed to have that at that angle of just looking at companies, right? So I do get it wrong, and I've gotten wrong. So that was obviously my biggest, I would say, loser, where I probably was down maybe 30 to 40%. When I found out, there were a lot of red flags, I immediately just sold off my position. And of course, I think it's now bankrupt, right? It was down to zero.
Okay.
Wow.
Yeah. So it is not easy. It is an art.
Yeah.
And I think in investing, we have to have losers.
Yes.
You have to lose in order to win.
Yep.
Like I said, I'm perfectly fine having losers.
Yeah.
But I think most importantly, the way that I would think about it is always like this, right? You buy excellence, you hold excellence, you add to excellence, and you sell mediocrity. So when I see companies like that straight away, I sell it, right? And so when I see, for example, okay, when one quarter, the revenues are down, something is off, I give it a second chance. Second quarter, if something is down, third quarter is down, I probably just sell the stock.
I see. So usually 3 quarters to probably a year. Would that be fair?
Yeah, it probably be so. I mean, I'll ask myself fundamentally, has the business changed? To give an example, right, of IT or the so-called the Netflix of China. It was when I invested in it, it was growing massively, correct? Then subsequently, revenue started come off the cliff. And then suddenly the last few quarters, if you're Netflix of China, your content is key.
Yes.
Right?
Yes.
You are using your content to attract people.
Yep.
And what happens is that they're selling the content.
Oh, my gosh.
Now, that is a red flag, right? Because you're not generating enough revenues and you're selling your content, which is supposed to be key, right? That was like, okay, something is wrong. And structurally, I looked at it, okay, I think I held for about a year plus, it was moving in the right direction, decelerating way too quickly. And when they are selling content, that was the last straw. And that's why I exited my entire position.
Right. I see.
Yeah.
Okay.
So it's really fundamentally, you get it wrong, you get it right. But I think you try to get it more right more often.
Yeah.
So let's dive a little bit deeper now into exiting positions, right? So I think you mentioned two already. One is when the management starts to, their chin is a bit high. So that's when right? And then the second one is about like some quantitative factors like revenue dropping and cash flow dropping and whatnot. So what are your criteria for selling?
So typically, I look at 3 reasons that I'm selling, right? So if I put all the other personal factors of selling aside, typically I look for it. The first one is just better opportunities. If I think this company probably will only generate, say, 10% returns on average over the long run, because where I look at Vision Capital, the way I do it is I look at a minimum 25% CAGR threshold. So if I find that this investment is only likely going to return me a single digit, 5, 10, 15%. It's probably below that threshold.
I see.
Then I probably might, reduce the allocation and move the allocation to a higher. I might not actually exit it fully, but I might start paring down the allocation over time. I generally don't do that, but I've done that actually for the first time just last year.
Okay.
Quite painful, but I think I have to do it. The other one that I have to do is really, I would say, declining fundamentals. When your revenue growth, when you first bought, right, revenue growth was double, 100% year on year. And then suddenly, within 1 year, it dropped to 20%, right? And then next quarter, it's become minus 5%. I mean, something fundamentally is changing wrongly in the business that is fun. So you ask yourself, is it fundamentally changing? Is it a one-off, right? Okay, COVID could be a one-off.
Yeah.
Airlines, COVID could be a one-off. If it goes back up, airlines will be fine. So I might not actually, if I actually own an airline, I might not do that because it was a one-off scenario.
Yeah,
right?
yeah.
But if I were to do something else different, like with a business, for example, in the case of IT, then it was fundamentally different. Then that would lead me to say, okay, this is declining. I need to exit the position, and I'll exit the position. Yeah. So this is one way of thinking, and the third one really is I got it wrong. Wirecard, I got it wrong.
Right.
I got it wrong. So when I got it wrong, you just exit.
Okay. Just going back to the earlier point about your portfolio sizing, and you had, if I'm not mistaken, 80. You said 80, right? Yeah. Is it all almost equally balanced, or do you have some clear conviction that means you put in a bigger allocation versus, or do maybe you just describe your rule of your 80.
Yeah, how do you diversify and construct your portfolio?
Yeah.
So the way I think about portfolio construction is about I let the winners compound and earn their place in the portfolio. So like for example, I think if I look at it, the top 10 winners will probably be maybe 40% of my portfolio.
Okay.
But because they were 40% because they compounded on their own.
Okay.
But actually I added the same amount. I used the same amount of money to invest back then that I'm investing now. So the amount of the money that I'm investing actually is the same. It didn't really change back then and back now. So it's just that they naturally compounded on their own.
I see.
So when I think about allocation, right, I don't aim to say keep that same allocation of it. I let it just compound on its own and earn its position in the portfolio.
I see. So will there be a point, or have you experienced a point where your compounders like became so concentrated that it became like 20% or 30% of your portfolio?
Yeah. So right now, I think the largest probably still hovering around 16%.
16.
I think it's a number that I probably am okay. I'm still okay. I think as David Garner likes to say, there's a sleep score.
Okay.
So what's my sleep score, right? I think if it's probably 25% and if it moves 10% every day of my portfolio, that I might pare it down lower. So I would say, I don't have an exact number because I've never come to that scenario, but I would say maybe 20-25% would be a number that I probably might not be too comfortable with.
Okay.
But then again, it's a very interesting theoretical question, right? Because your winners are just growing so big.
Yeah.
And if you're actually powering down your number one winner to move to other lower winners, you're actually depressing your overall returns of your portfolio.
Yeah.
So I think you need to let it concentrate on its own, but also we need to be cognizant of that thing. So you're actually powering down something that is probably returning higher for a reason to something that is lesser returns.
Actually, Peter Lynch had a phrase for it. It says, it's like killing your flowers and watering the weeds.
Yes, never. You always water your flowers, do not water your weeds. So I never add to my losers. Yeah. I always add to my winners.
Yeah. Okay.
Right.
Great.
So, I mean, one thing that struck me about having an 80 stock portfolio is that is a bit of a trend bucking thing. What I mean by that is most investors that have done extremely well, right? You're talking about the Buffetts and the Mungers and the Greenblatts, that they run concentrated portfolio, right? And if you ever ask them anything about the diversification, they say basically, why put your money into your 20th best idea when you can put it in your 5th best idea. And I would say that most of the time when I look at people or funds that have 80 stock portfolios, right, they don't do well actually. And I think only
Lynch.
FIRL Lynch, which had 1,000 over stocks, but actually I never know whether it's split into many different funds.
True. It's true.
I can't remember. And I think we have a close friend, Stanley. I think you know him as well, right?
Stanley Lim.
Invest Asia.
Yeah.
I think only like 3 of you guys globally, quite frankly, it comes to mind when it comes.
Oh, another one, AAM, Aggregate Asset Management.
Yeah, but even them, they are having a tough time right now.
Yeah.
So I would say the three of you guys have done pretty well. Bucking the trend. What do you think that is? What do you think that concentration is just not necessary?
So the way I think about it is, if to put it this way, right? Everyone has different styles of investing. Right. You can be a 5-stock investor, still do well. You can be totally like Lynch, have thousands of stocks and can still do well. Yeah. I think the difference between Lynch and a concentrated portfolio is like this. Lynch can allow a stock to go 50x and it doesn't need to sell. If you have a 5-stock portfolio and the stock 50x right away, you'll be constantly selling it.
Oh yeah. To par down.
You'll be constantly selling it. So I give you an example, right? Let's put some math, right? You have a 5-stock portfolio, one stock just became 5x.
Yeah.
Right? Yeah. The stock has literally become your largest portfolio, right? Yeah, right? And you'll be like, oh my God, right? And if one day the earnings is bad, it minus 10%, you're down 10%. Like you're down 8% because maybe it's a percentage of and stuff, right?
Yeah.
But I'm trying to say you're getting hit and you're forced to sell your biggest winner. And you're powering out your next best idea. Now, so it's a bit different. Yes, at the start, you're investing in the top best 5. But what happens is that mathematically, you actually always end up selling your top idea and powering down. So you might be doing your best 5 ideas, but mathematically you're actually accelerating that and actually reducing your overall returns much more over time.
Okay.
Yeah. So that is one way I think about it. I can let my stocks 5x, 10x, 20x, 50x, no problems because of that.
Yeah.
And the way I think about it is every stock in the because when I mentioned just now, right? Because the maximum a stock can go down is minus 100%.
Yeah.
It can be a multi-bagger. So I think about every single stock is like a call option. Now, so when I have a portfolio that I have 80 call options. When I sum up the payoff of a stock of 80 call options, right, it actually looks a very big triangle and a very small triangle of losses. So it actually looks like a massive call option. It does not look like an ETF or a unit trust.
And with no strike price, right?
Exactly, right?
Yeah.
Exactly.
Perpetuating.
That's the way I like to think about portfolio allocation and construction from that standpoint. When you're constructing your portfolio to be massively long a call option and a portfolio of call options, that is how it works.
Yeah.
Right.
Have you ever done shorts before? Have you short?
You short? What do you think of short?
No, so we don't do any leverage, no options, no hedging.
So boring. Eugene, why so boring? So you don't think it's necessary for things like that?
I don't think it's necessary. Right. I think everyone has their own niche, right? You can do it and stuff. The way I think is, why do I not do options? I mean, okay, let me put it this way. Let me put covered calls and stuff aside, right? Now, I can sell an option. So let's put it this way. If I want to, for example, like I want to profit from something, right? So if I can sell call options.
Yeah.
So for example, let's say a price is $50. I want to sell calls at $60, right? Okay. The stock price, sorry, am I getting it wrong? Okay, so let me change it this way, right?
Okay.
Because I don't do options so clearly.
Don't worry, we don't do.
Okay. So you can sell call options, right? So for example, right now, what happens is that when the price goes down, your call options get exercised. And you actually end up losing money. Now, what happens is that fundamentally you cannot market time in the sense, right? So you cannot say, for example, when stock prices come down, I cannot say I want to buy more stocks. I'm forced with a position that I now have unknowingly I got the price.
Yeah.
I might be earning, I think about it as, again, back to the retail company, right? I'm trying to earn this small amount of money, but I have unlimited downside. Why do I want to do that? I only my favorite payoffs are limited downside, limited upside. So if I'm selling any options or doing any covered variations, it just makes my entire payoff that way, right? Limited upside, unlimited downside.
Yeah.
And then structurally, again, it just reduces my overall returns. Yeah. So that's why I've never tried to do that. I don't bother.
Yeah.
One of the things that your strategy reminds me a lot about is actually VC or angel investing, right? And I know that you are, correct me if I'm wrong, I know that you are into this space as well. So you want to share with us a little bit about that?
Yeah.
Yes, correct. So I think this really goes back to my life mission. So my life mission is to excite, to inspire, and to empower people to pursue their dreams and to grow their businesses, to create long-term, sustainable, positive value by making the world and mankind a better future. And when I think about it, really, Vision Capital is investing in the public space, really helping the world to invest better, teaching the people the world through my book, right, Vision Investing, to help people to invest better. But with that, when people invest in better companies have to become better. That generates a flywheel of its own, right? And I'm also helping people to become better investors. Now, when I wanted to move into angel and early stage investing with Vision Capital Ventures, was really, I wanted to move into this space, ultimately to fulfill my life mission as well, help back entrepreneurs to create businesses. And ultimately, having a position, and driving startups, driving in the forefront of technology.
I see.
And ultimately, when all these startups become listed, they could join back my main portfolio, my main fund, which is Vision Capital, and that creates a big flywheel of things. And the great thing about when I'm investing in this realm, right? I'm already investing in the future. So I'm already investing, in 5-10 years ahead, right? Of where the companies are. And the good thing about in angel and early stage investing, you're investing even way ahead of the time. So I'm investing the next 10 and 20 years already. I'm seeing things that are probably only going to come live in 5 years' time or 10 years' time.
Right.
And that's very exciting because you're really at the forefront of technologies, seeing tremendous things, that people are not even talking about, not even reporting in TechCrunch, not even reporting in the news. You don't even see any of that. And they are slowly just changing the world.
Understand.
You're just curious, and feel free to not answer if you find this to be to be sensitive or anything. But what is the AUM right now for Vision Capital?
I would say it's a 7-digit portfolio.
Nice.
Yeah.
Okay.
So it's been growing.
Okay.
And I do hope, if in investing, right? If you throw a CAGR, so I look at 25% CAGR.
Yeah.
Right.
And in 30 years, the number it ranges between 200 million to 1 billion.
Yes,
Wow.
correct. Because
Yeah.
it doubles every 10 years.
It doubles every
adds
year.
a zero every 10 years.
Correct, because it compounds. So
Yes.
if you think about it, like in Warren Buffett, right, 95% of his wealth, I think, is probably made after his
60th.
65 or 70th birthday, right? And
Yeah.
exactly the same thing.
Yeah.
So I'm hoping it gets there because eventually I also want to set up something there's philosophy that I want to set up a charitable fund that also drives back and gives back also by education.
Okay.
So that's what I'm hoping to as well. So it's this entire flywheel.
I understand. Eugene, going back to VC, right? What advice would you give to retail investors that have an itch to scratch when they want to go into VC investing? Do the same skill sets apply for public markets to VC? And if there is there's a difference, what would be the additional skills that you would advise investors learn to go into VC investing actually?
Or angel.
Yeah.
Yeah, I think in public investing, right, 20% of the companies account for probably 80% of my returns.
Okay.
And in the early stage and VC space, right, probably like 5 or 10% of the companies will account for 90% of your returns.
Yeah.
Right. When you talk about multibaggers, these are like unicorns. Like you're looking at really 100, 200, 300 baggers. Because these are life-changing companies that were basically, like a lot of the VCs, because they invested in Alibaba.
Yeah.
You look at SoftBank, for example, right?
Yeah.
Because they invested in Alibaba, and the likes and stuff, and that's why they got so big,
Yeah.
right? So it's really that kind of payoffs. So that payoffs just get skewed even more. Firstly, you got to be really understand of that. So majority of the numbers, they will say 90% of the startups actually fail. So I'm hoping that with the way I'm choosing and selecting companies, I don't get maybe 90%. I hope maybe I get 60% or 50%, right? And hopefully, some of these companies they can become 100x. So I'm looking for 100x exits, right? The way I'm thinking about angel investing is that if I think a company can only be 5x or 10x and the market opportunity is not large enough,
Okay.
then that is not good enough for me. Because if you think about it, if I have 10 investments, it's only a 10x, and if I lose 9, I'm going to be flat.
Understand.
So you really have to be finding 100x opportunities, because these 100x opportunities are the ones that are going to wipe out. They're going to basically pull your portfolio forward across all your other losers.
Understand. What are the traits that you so far from your sampling and your experience, right, that differentiates this 5 to 10% of the companies that succeed? Is it management? Is it purely just the TAM? Are they in the right place at the right time? Or what is it? I mean, from your experience.
The couple of things. So in angel and venture is very different, because in angel and venture, you're really investing in the people. Two founders can change the direction of the company more than anything else. Because when you're investing in a very large company, even if the founders move or anything, right, it doesn't really change. They can hire a new professional manager, and they can. Whereas in the very early stage seed rounds, the founders drive everything, and the founders are everything. So you really got to be, again, investing in people. So you tend to have a sense, okay, who are these people, right? How have they been? I tend to find calls, but the problem with angel investing and stuff, because some of these people are very young, or some of them could be also very old. They could be doing startups and stuff. You might not have enough videos of them speaking, hearing, and that tends to be tougher.
I see.
But I think the world is nowadays, because people are being more public.
Yeah.
That problem becomes less of a problem. And that's how you get a sense. And ultimately, I'm finding founders, I'm finding the business. I'm looking again, similar, right? How I think about public. Is the business an opportunity that is growing massively? Are they truly disrupting something?
Okay.
And getting towards that direction.
I see.
So I'm really thinking, let me give you an example, for example. I invested in this company. I won't share the name.
Okay.
So it's a startup. So this startup basically is trying to do fertilizers as a service. But let me try to explain.
FAAS.
Yeah, FAAS.
So what happens is that fertilizers are generally made via a very inefficient process called the Haber-Bosch process.
Yep.
Basically, you make it via, think about it as a very large factory, a lot of electricity, a lot of raw materials.
Yes.
You make it finish. Once you make it in a big factory, you eventually have to transport it long distances to the farms.
Yes.
Right? What this startup wants to do is basically have it in a box in the farm.
So localize.
All you need solar, water. Because what is in fertilizers? Nitrogen-based fertilizers, right?
Yes.
They're all nitrogen, right? And we have nitrogen, majority of our air is nitrogen, right?
Yep.
Through that, they create nitrogen-based fertilizers. And then basically they dilute it by parts accordingly, put it in the farm. They are changing the world. And I hope they can change the world. So some of the founders are basically, Forbes 30 under 30. They are Harvard. They have gotten grants from even Harvard, for example, to show that everybody's interested in the technology. They are right now in the farms. They're in 3 farms. They've actually, take off all their shirts literally and move into the farm somewhere just beside the farm.
I see.
They're 24 hours on this so that when it fails, they are there solving the problem and fixing it. They're trying to get it up right for 3 farms. If they get it right, I hope they do get it right. It will fundamentally change the world and make it better.
Sorry to interrupt. Go ahead.
Yeah, so I mean that's really, really how, right? Vision Capital Ventures is nothing but an extension of Vision Capital. Really just finding such companies that are just changing the world from that standpoint.
Yeah. How do you, one, get into pitches like this? 2, is that do you find them locally within a region, or is it mainly outside? Sad but true.
Yeah. I think in angel and in early stage investing, your deal flow is very important. Deal flow meaning you have to see the companies, because only when you can see, then you can reject.
Yeah.
You can't see, you can't reject, right? So your deal flow, typically you have deal flow that, people come to you on LinkedIn, or they come to you via random and and they send you PowerPoint decks and you kind of look through and you meet them and you talk to them. That's one way, right? Your own deal flow. The other deal flows, you can have it via your networks. You have other people that other angel investors. They see this company, someone's reached out to them, they forward it to you as well. The other ones that we can use also are syndicates. I probably won't mention the names of the syndicates.
Okay.
But you can use syndicates where people are syndicating a particular round. You can have angel investings into those rounds, and you can basically co-invest with other angels.
Understand.
Into a particular round where someone is syndicating those rounds. So kind of, I would say broadly 3 ways that you can do it: direct, or through your own, through other people's network, or then through syndicates.
Understand. Region based. Here.
Region based. I look at global. I've not found any Singapore startups, but though I'm actively in that space,
I see.
Just looking to try to find anything. But so far, I think largely has been, I would say, US, Europe.
Okay.
And even in Asia, actually in India, I have a couple of 1 or 2 startups in India as well.
I see. Okay.
Yeah. So Europe, largely Europe, Asia, US, and India.
Okay.
So you shared with us so much about your time in public markets and also more private markets, right? So what would you say is, let's call it your top 3 biggest learnings, right? Because you've been investing for almost 5 years, which is a market cycle, and you will definitely come across very unique lessons specific to you, or maybe not, right? So tell us, what are the biggest lessons you've learned? Top 3.
I think one of the biggest lessons to learn is, I think everyone can really outperform and beat the market. Investing, I think about investing is a direction, right? Every day, the stock price can go up or down. Price volatility, it's a given.
Yeah.
It's the emission, it's the fee that we pay to be invested.
Yeah.
Keep focused and always be focused on the underlying business. Are the revenues growing? Are the profits growing? Are the profit margins moving in the right direction? Are the cash flows growing? Right? Is the business gaining customers? Is the business delighting people, your customers? Are they delighting suppliers? Are they making the world better? When you do that, the business will grow. I can tell you, we will. The stock price will grow.
Yeah.
But I won't know how when it will come down, when it will go up, right? I know directionally it will be there. And so I think what I have learned, is that when you start being invested for 5 years in the market, whenever you have a market downturn, right, like recently, there has been a market downturn for a lot of the companies that I own as well. Because like you ask yourself, what fundamentally has changed last month versus this month, right? My company is still doing well. It's been growing. It's been delighting customers. Okay, the stock price down 25%. Great time to add some more? Yes. So I think fundamentally it makes me think that sell-offs actually are great opportunities, right? To add, because I'm a business-focused investor, not a price-based focused investor, not a technical investor. And I think that is one biggest learning for me, right? I mean, really, price volatility is something that is just something that you have to pay. Declines are normal, are part and parcel about this. So I think mindset and psychology from this aspect is so important. And to put it this way, right? One of the biggest things is also about this. Yeah. Why we choose long-term investing is on any given day, a stock can go up or down 50%. Okay. Actually, the number is about 51% because stocks have a positive skew because stock prices go up over time. So actually 51% of the time, you actually probably make money, and 49% you actually lose money. But when you go up to 10 years, this number, the probability of winning goes up to 80%, 70 to 80%. When you go up to 20 years, the probability goes up to 100%. Okay. So if you're a long-term investor, right, there's a 100% chance you won't lose money.
Wow.
Now, this fundamentally changes things. I'm playing not a game where it becomes random and a coin toss. I'm playing a game where I know the probabilities are stacked in my favor. So as you can see, right, from the whole entire session I'm trying to share, I'm stacking all the probabilities in my favor. And when I invested for 20 years, right, in great companies, 100% I won't lose money, So actually now, that's why I told you I got downside, right? Now actually I got no downside.
Yeah, man. As long as you stretch it.
As long as you stretch it, right? Yeah. I got no more downside anymore. So my downside actually is a call option with zero premium. It's just that it's a 20-year call option. Yeah. It's not a 1-year call option now already.
Yeah. You never need to unwind your position.
Never need to unwind my long call option.
Yeah.
So if something is 100%, Eugene, why do so many people not do it?
That goes back to the fundamental thing because so there are many tricks, right? And one tip that I've done is this, right? I don't look at my stock portfolio or where the number is every day, every minute or every hour. I look at it only twice. One, after the market closes, which I know I cannot do anything. And then the only time, obviously, if I look at it when I'm forced to look at it is when I'm buying stocks. So I typically buying in night time, our time, which is early morning, the US time. But I don't even look at the number, right? I just want to go in and buy the stocks and buy it at market. I don't care whatever price it is. I just want to go in.
Okay.
Yeah. So the way that we always think about it, don't keep looking at your portfolio number. It does not change anything. It makes you happy. What if you up $500, up $1,000 up? It really doesn't change anything. Yeah. We need to be thinking about, fundamentally, is my company's going to be growing? If the revenues are growing, let me put it this way, right? If your revenues are growing 50%, right, the PE is trading at 30, right? Next year, the PE is going to drop, no?
Yeah.
If it drops to 25, right, your stock price is going to go up some more still.
Yeah.
So I think I don't think about P. I don't do any Excel DCF valuations. I just really think about, what is the PE and what I think the earnings growth is, and I weigh it. So I give you an example, right? If a stock is growing earnings 25%, I can tell you on average, assuming the PE is not 1,000, right? The stock on average should grow between 15 to 25 to 30% CAGR on any given year,
right?
Simply because, the stock market is basically made out of businesses, and businesses are made out of real revenues and cash flows and profits.
Yeah.
So you mentioned PE, right? So what happens when there is no E?
Yeah.
What happens if there's no earning?
When there's no earnings, I actually look at cash flows. Now, what happens is that there's a very interesting thing. So E is important because I look at losses. If a company can be making losses, but if their profit margins are moving directionally, I give you an example, right? A lot of these companies, for example, because they're so scalable, let's give an example. One company, maybe their EBIT margin is minus 50%. You say, oh my God, they're losing so much money, right?
Yeah.
But what happens is that, if I tell you, the year after that 50%, the EBIT margin becomes minus 25%. Does it change now?
Oh, yes.
And then the following year now is minus 5%. Now you've seen, now as an investor, right, you only have seen 3 data points, minus 50, minus 25, and minus 5%. Now I can tell you, directionally, I know where it's going to go.
Yeah.
So what happens is that as an investor, you need to break it down. First, find out what's the gross profit margin. If the gross profit margin is high enough, I give you an example, the gross profit margin is 80%. I have 80% to play with. Next, I find out what is my three expenses, right? R&D. R&D, typically, please, I don't want it to go down to zero.
Yeah,
because if you go to zero, you're not investing in your business.
Not growing.
Your company will fail. So R&D should ideally be flat or ideally increasing, but not keep increasing.
Yeah.
2 things I like to look at is SG&A. We've got selling, general and admin expenses.
Yep.
And the other one is, what's my favorite, is sales and marketing expenses. As a company should grow, this as a percentage of revenue should decline. So I like to look at what's the percentage of this. If a company is truly scalable, right, you don't need to spend the same $100 to attract 1,000 customers. You should be able to spend same $100 to attract even more customers. And that's where your selling and your SG&A and your S&M actually drops as a percentage of revenues. And that's where your EBIT margin grows, your EBITDA margin grows, your net income margin grows. And of course, your free cash flow and your OCF, operating cash flow activities, just fly through the roof. No, that's how I look at it. And the best kind of companies, the good thing about it is when they're not profitable and when they're turning massively profitable, that's where the valuation multiples jump even more. That's where the stock price jumps even more. Yeah, so I wouldn't say just because they're not profitable, I won't invest in them. I'll actually look at where their profit margin trend has been. Okay. I look at where management think the long-term margin is. I look at every quarter, right? Let the data tell me. Does it have scale? Does it have operating leverage? There's some companies that actually you realize they don't have operating leverage on. Every quarter, right? They only end up spending more and more sales and marketing.
Yeah.
That's a red flag. Because if every quarter they keep spending enough sales and marketing to keep the same revenue growth, right? Something is wrong. So that is a clear red flag from a business model to me.
Understand. What do you think on share-based compensation, especially if a company is losing money at that point and using share-based compensation to attract talent? Because in a way, it's not direct cash, in a way. Yeah.
I think share-based comp goes back to dilution.
Okay.
I think share-based comp is a good way to keep employees, because typically share-based comp, you have to have vesting periods. Yeah. They need to be around for years. It's a good way to align the incentives, especially for early startups, to grow there. So I'm not against share-based comp, but I'm against excessive share-based compensation. Okay. So again, I think it ultimately goes back to dilution, how much dilution goes down in terms of the share count. Okay. It goes back to it.
Do you have a ballpark figure on the rate or?
I really don't look at it. I mean, it really is what the number is. Okay. Yeah, I think just now MJ brought out a very interesting point about earnings, right? Now, there's something very interesting about earnings. In the past, a lot of the companies were companies that are physical. Yeah. They had to spend factory equipment.
Brick and mortar,
right? Now, when you spend this, right, what happens is you end up having depreciation. And they spend a lot having on the cash. Yeah. But slightly different now, actually over the last 20 or 30 years or so, for a lot of our technology companies, is that when you're spending in all this R&D, right, R&D gets expensed right away.
Yes.
You don't buy an asset, depreciate over time, and your earnings actually looks quite good, right? Yeah. But what happens is that artificially, because you actually not even capitalize, right? All your R&D gets expensed. Your companies actually look artificially not profitable right now. Yeah. Correct? When I spend all this money developing my IP and my infrastructure and my technology, later what happens is I actually end up spending lesser. Yeah. And that's where the profit margins actually go up a lot. Yeah. So when you talk about E, right, it's actually very nuanced in a sense, because I would think about as physical assets versus intangible assets. Yeah. And intangible assets are all now actually being expensed. Yeah. That's physical expense, whereas physical assets in the past were actually all being depreciated. So actually, I look at cash flows now more, because cash flows actually are a much more better indicator. Yeah. Versus that. Yeah. Yeah. Versus earnings. So I find cash flows numbers to be of a better quality. Yeah.
Actually, the statement that you made just invoked my memory on the S&P or the top market cap company in the US about 10 years ago, or was it 15, was Exxon.
Yep.
And today it is, so I think you wrote a very interesting article called The Rise of Intangibles or something. It was a very good read. I think I'll see if we can find a link and I'll put it into the show notes. But I think key to what I got from you from that article was that the data points of the changing trends in how businesses are conducted today and the changing trends in which expenses are actually recognized, because accounting standards have not actually kept up with the times. I don't know whether you agree with me with that statement. And the struggle is that a lot of people or the valuations are based on a lot of these old accounting standards. And I think the struggle for most people to do valuations or understand valuations today is really to declutter all these old accounting standards and to really be a business-centric, understanding the business-centricity of this. Because who would have guessed, 15 years ago, Exxon would actually have a downfall today, actually. What are your thoughts on that?
Yeah, I know. I think you're absolutely spot on. I think accounting standards have I would say lagged and not caught up in a sense. Yeah. And that's why I think as investors, right, we need to be not just we need to be as Charlie Munger says, having a lattice framework of understanding the world, right? When I look at accounting helps impact us as investors, because if they impact the quality of the earnings, it impacts us because we are looking at the earnings and to see it grow. So because we know it artificially depresses earnings, companies are actually artificially, not earning a lot of money. But I'm sure you have seen a lot of companies actually are not earning a lot of money, but somehow their cash flow margins they're free cash flow positive.
Yeah.
We should be asking ourselves the question, why are they actually free cash flow positive when they're not earning money, right? Because all this actually, they are just expensing.
Yeah.
Right?
Great.
And that fundamentally changed a lot of the framework. So when we look at from a PE, these are actually PE very high, but when a lot of these profits just jump through the roof, the PE just goes straight down.
Yeah.
And what happens is that because a lot of the companies, they're just premium-based companies, they're just top companies, they actually still stay very expensive and they trade expensive. When they trade expensive or on a premium basis, right, the share prices just go straight through the roof.
I understand.
Yeah. So I think that's really one way to think about it. And us as investors really just need to be cognizant of many different angles and different aspects about the world and its implications for us.
Yeah. Great. Enjoy.
All right. So, wow. Coming up to 2 hours. We still have a couple of questions, actually. Actually, we have more. And, I hope once, COVID's over, definitely we will
waiting for you to bring us around and save us Singapore food, okay?
Yeah, just bring us to discover the second best food in ASEAN. So, anyway, I just want to get, now, we talk very deep into things like accounting, things like financials, time and all that. Let's take a big step back. Where do you see the market, right? Last year was a fantastic year, obviously. I think if you bought just about any stock that was intact, right, you would be a genius, right? You look like a genius. And so how about this year, right? Where do you think right now with COVID somewhat subsiding, with vaccination, with what some might think to be one of the longest bull market ever in history, plus the fact that tech seems to not be able to go down at all. Yeah. Stimulus, whatever. Okay, Biden. Where do you see the market this year, 2021?
The market basically goes up 7 to 9% on average over the very long run.
Right.
The short answer is I have no idea.
Okay.
The way I would think about it is a lot of the companies actually have gotten a COVID bump because COVID has accelerated that. So a lot of them has had a massive tailwind of revenue growth put forward.
Yeah.
Now the question, I guess, because of that, they will have very high base effects year-on-year comps. So from a year-to-year comps perspective, it's going to be challenging.
Yeah.
Now the question is, I suspect it's probably the next couple of quarters. It's probably going to be challenging on a year-on-year basis.
Okay.
And the question is, after this comps stabilize, right, the following year-on-year basis, they'll be back to their own normal, right? If a company was growing 30%, but because of COVID, they jump 100%, right?
Yeah.
So my year-on-year comps for next couple of quarters is going to be challenging. And market might think, these companies are slowing down. But actually, no. I mean, maybe the revenue number is still actually higher than the previous quarter, right?
Yeah.
And that is absolutely perfectly fine.
Yeah.
Right.
But the way I think about it is because the market just looks at just kind of year-on-year numbers because of base effects, they just temporarily might shift back to value-based investing or some sort of value stocks that so far has been doing, which I think is perfectly fine. But there was always recommendations to do all that. I think I have no issues because my companies are still growing. When you're still growing earnings 20 to 30% year on year, right, over the long run, I have no worries. I'm not looking at the next quarter or the next. I might underperform the next quarter, 1-2 quarters, but I know over the long run, I will do fine. And so I think ultimately it's being just having that, staying invested. Don't try to change around. Be comfortable what you are investing. You're investing in businesses. You're not trying to time the market. You're not trying to time the price. You're not a price investor. You're not a technical investor. Right. Really, just keep focusing on that and invest in that. So I think I can tell you, the market will probably be up more than it's down. Yeah. But I have no idea where it's probably going to be.
Great.
So staying on the macro discussion, right? I think one thing that a lot of people have concern right now is excess liquidity. A lot of people are saying, and I always like to say they're a bit the saltier investors, right? Who didn't invest in 2020, and they're saying these tech companies have no assets and they're phony business model, whatever it is, and so and they say the only reason why these tech stocks has gone up is because the Fed is essentially printing money, and that's why you can support liquidity. Every time there's like a little bit of gyrations, and then Jerome Powell will start to buy buy assets and treasuries and whatever, right? And globally as well. So what do you think of this phenomena? Because this is probably the first time in history probably where we have so much cheap money, helicopter money or whatever in the market, and that is creating all sorts of distortions, right? The word they use is distortions, is artificial and all that, and all of this has to come to an end. So what do you say to these doomsayers, doomsday opponents,
Yeah, I think if you think about it, right, 10 years ago, Amazon was overvalued.
Oh yeah.
5 years ago, Amazon was overvalued. Today, Amazon is still overvalued. I mean, it hasn't changed, right?
Yeah.
Correct. So I mean, the mindset of the market hasn't changed. Ultimately, we need to be really being a business-focused investor,
right?
And ultimately asking ourselves, right, what is the companies doing? Why are they growing their revenues, right? Are they growing their revenue just because the Fed is printing more money and buying the stock? I think if you look at the Fed printing money, they're actually buying bonds. Yeah. Now, they're buying these bonds from people who are owning bonds. And if people are owning bonds, you think they will buy stocks? They'll probably be owning less risky. I mean, they'll probably move up the bond credit curve. But I don't think there's actually that significant a shift towards buying equity. So you look at equity inflows versus bonds, it's actually a very different picture.
Uncorrelated, would you say that?
I won't say it's uncorrelated, but I'm saying it's an extremely different picture. We can't just say, for example, the Fed has pumped this amount of money, and this amount of money went entirely into the stock market. I think a more discerning investor needs to really fine tune and find exactly the numbers, right? You can say, I do have an example, right? Biden recently, the Biden administration recently had money, given money to the US guy. If I remember, it was about $700.
Yeah,
something like that.
Yes.
Now, if you're giving money to a person who can't even afford the next meal, would they be buying stocks? Yeah.
Right? Well, you just never know.
GameStop.
Exactly, right? Yeah, exactly, right? Now, so my question is, yes, I would never know. The younger guys might probably do it. But I'm trying to say, we need to read beyond the number, right? Yeah. Is 2 trillion really going to the stock market? No. 2 trillion, there's infrastructure, there's a lot of things. Yeah. And actually, the entire payout of the entire 2 trillion was actually a very small percentage.
Yeah.
Right? I mean, we need to really look in the context and look beyond the headlines, the media headlines that are given to us, and over sensationalize these headlines and really go into the fine print and dig into it. And once you dig into it, you actually realize it's actually not what it seems to be.
Actually, I know there was only 2 questions left. Just another one just popped up. Right? I think what we have talked a lot about in this podcast is about your investment strategy and how to look at investments. A lot of our listeners, one of the big challenges is, they find all this stimulating. It's great, great information, but they struggle, right, to actually, in terms of the personal finance space.
Yeah.
Right. I know this is not necessarily your specialty, but certainly to be where you are, you need to be decent with money, right? And so what you say, right, is the most important thing for someone starting out, let's say, or someone who has very little in their bank account, where they listen to what you say about Vision Capital and it's like, wow, so amazing. And I want to be like Vision Capital. I understand the skills that I need in terms of investing. I read the books, I listen to this podcast or whatever, but I just don't have that amount of seed capital or that first big savings to really make a dent in their financial universe, right? So what are your personal finance tips for people like that?
I think it's a great question that you're asking. I think when it goes back down to this, it really goes back down to the fundamental truths of financial freedom. And in financial freedom, the fundamental truths is really one: earn more, make more money, spend less, save more, invest more, invest well, and keep repeating. It's really that simple. Now, let me elaborate more, right? Now, if you have a job, work at your job, earn more money, right? And if you're spending, save, be disciplined. Don't spend everything.
Yeah,
save it. Right, but of course, don't save everything and not every day just stay at home and be a happy person. Right?
Eggs and Maggie Mee.
Exactly, we have to be a balance because ultimately we are running a marathon, not a sprint.
Yeah.
Correct. Save, because that ultimately these two things will just lead to savings.
Yeah.
Right.
Now, spend the time. Read, invest properly, spend the time, and eventually you get to learn. When you invest well, the whole thing just keeps repeating. And it's just really just down to those fundamental truths, and it really is. I mean, I wrote my book, Vision Investing. It's really meant to be for the average investor wanting to invest, because it really just runs through the entire math of why investing becomes a game, and a game that is, if you do it right, is rigged in your favor. You can keep outperforming, you can keep beating. So if you invest in those right directions, I'm always skewing the probability in the right direction, and you can just keep doing well. So that's really, I would say, this flywheel, right? Just keep repeating this and just keep doing this. Ultimately, read, invest. Don't look at the stocks all day long.
Okay.
You absolutely don't need to, right?
Yeah.
And just keep doing this.
Yeah.
Right.
This is probably, I guess, the biggest tips that I have for anyone.
Yeah. I just have one question on his sporting life, and then
sure. No, I actually have a little bit of follow-up question. Maybe you ask that question right after. It's linked to this question, right? Okay, so I think you talk about investing, and actually the last question was actually about your book. So you've already shared it, so you answered it. Great. Can cut short this podcast a little bit by 2%. Yeah. So actually you talk about earning money and saving more. Now, don't go super in depth. I know you like to give examples. Just give one right now, okay? But basically, in terms of earning money, so you come from a corporate background, right? So obviously, I think you'll be best qualified to answer, right? In terms of a corporate setting, what is your top tip to earn more? And then for saving money, what is your top tip?
I think to earn more, ultimately, you always have to be delivering value. Because I think money is an important way, because money is a way that basically measures the amount of value that you give. I think about money as that way, right? And if I'm paying someone because they've delivered value to me. Now, when you've delivered more value, naturally you get paid. It's only a matter of time. Someone will recognize you, someone will pay you, right? So I think that is important. Balance that. Don't work all the way.
Yeah.
Right? You can make all the money, but if you don't have any time to do anything else, that's going to hurt you as well. I think you find that balance, find that sweet spot that you have, that ultimately balances up. I would say, lead a fruitful life. Experiences are important, right? Material things are not, right? You don't need to show off your wealth. Like I think Morgan Housel gave an example, right?
Yeah.
Though a person who drives a Ferrari, I actually think that the person is $500,000 poorer than me.
Wow.
Good example.
You heard that? You Honda Civic drivers?
Or your Myvi drivers?
Yeah, you're 120,000 poorer than me.
Yeah.
That's right.
No, exactly, right? Because why do I need to buy something when all I need is just to get from one place to another?
Yeah.
Yeah, lah, but you're Singaporean, ma. Nah, just kidding. Yeah, but good point.
Yeah, correct. I mean, so if you think about it from that standpoint, you really, why do you need to spend something just to impress someone? You really don't need to impress anyone.
Yeah.
Is that your biggest saving tip?
Yeah, it's really my biggest saving tip. I very few material things because there is really not much for a need to.
Yeah.
And you just leave life simple. I'm better off, investing in people, investing in companies, and that makes me happy. Okay, so I'm using my capital to spear the world in the future. That's great.
Solid. Okay, water polo.
Yeah, exactly. Oh, you read my mind, MJ. Did your sporting or athletic background in somewhat help you to invest better?
Yeah, absolutely. I think sporting, a team sport especially. So water polo is a team sport of 13 players. We play in a pool. It's a bit like, think about it like soccer, but you play with your hands.
Okay.
And you try to score goals basically.
13 players aside, is it?
13 players aside.
Wow,
seven playing at any one point of time per side.
Oh, okay.
So 14 people in the pool at any one point.
Yes,
right.
correct.
Then you got 6 subs, basically.
6 subs. Correct.
Okay.
Yeah. I've been playing. The thing about water polo was, I think sports teaches you grit, teaches you determination, teaches you hard work. Because when I was playing water polo, I was having trainings about 11 times a week.
What?
Every
twice
morning,
a day.
every weekday morning, every weekday night, every Saturday morning. Yeah. To have that kind of grit and determination and focus is of a different level. So I think what sport really teaches me is that when you really focus very hard on it, you can become great. So to give an example, right, just to give an example as part of the closing. So when I was one of the oldest players actually to make the Singapore SEA Games water polo team. This was back in 20, if I'm correct, it was 2007 SEA Games. I made a conscious effort to say is that at the end of every game, I needed to reflect upon what I did better and to keep reflecting and keep visualizing.
Okay.
And when I actually did that, I had tremendous growth. Because I realized you start becoming better and better. What did I change during that training? I could have done this better. I could have changed this better. Let me tweak it. And I keep visualizing this 5, 10 times, 20 times, 50 times. And the next time when the ball comes I know where exactly to pass the ball. Because I have replayed this 50 times already in my head the night before. And I know exactly when this thing happened again, I'm going to have it. So what happens is that I've actually conditioned my mind and I keep reflecting on all my mistakes and actually pushed it all out. So when I did that, that was a learning journey because I realized when you keep learning, you keep improving, you keep trying to, and keep reflecting, you actually end up becoming better. I think that as a sport itself, I think that just a commitment. Yeah. So for example, so every day I wake up at 4:30. I spend 3-4 hours of my day, the first part of the day, just looking at investing, looking at companies, reading, and doing. I start my day really early. By my own choice, right? I could wake up at 7:30, 8 o'clock, but no, I want to wake up early because I have more time. To do more things outside of my other stuff.
Great.
Yeah.
More questions?
No, I think obviously if you want to ask, we can go on all night long, right?
We can.
But he needs to wake up at 4:30. Okay, so
Well, Eugene, it really has been an absolute pleasure. And this will be up there in terms of one of the longest.
Definitely,
and it's not just about being long; it's also about the insights that you get, right? Because one of the targets of this podcast is to unearth this sort of, hidden, investors who have done well, but people don't really hear about, and they don't know their process and all that. So thank you so much for sharing so much, I think, of your process. Now, where can people find you before we go?
Give a shout out to where people can find you.
Yeah, I'm on Twitter, so it's Eugene EUGENE NG_VCAP.
Okay.
Vision Cap, so it's VCAP.
Okay.
I'm very active on Twitter. You can find me there. I tend to share a lot of stuff. about my thinking.
Do you have a blog or anything that?
No, I do have a Substack. So if you go on my Twitter, you can find my profile. I have newsletters that I send ad hoc.
Okay.
Every other couple of weeks.
Okay.
They do take a bit of time, so I tend to when they're really thoughtful, and then I send them out. So I don't try to make an effort to send one on a weekly basis or not. So on Twitter is where you can find me. And I think that's the best way to reach me.
Great.
That you can DM me and stuff. No issues.
Great.
Okay. Once again, thank you so much for being on the podcast. Looking forward to a part 2, perhaps in the future. Maybe we can talk about individual specific stocks, right? Some of your ideas.
Or we can record this in Singapore.
Yeah, maybe, man.
If the borders open up.
I don't know. Malaysia say it's Q3 or Q4 vaccination, but I don't know. You never know, right?
Yeah.
You never know.
Yeah.
Okay, thank you so much for being on the podcast. And guys, I hope you all enjoyed this blockbuster podcast, or at least it's a blockbuster to me. I don't know about you, John.
Yeah, definitely.
And guys, see you in the next podcast.
Yeah.
Thank you, Lord MG. Thank you, Lord John.
All right.
It's been a delightful session with you guys.
Thank you.